Most founders are sort of saying that they start with equity. That certainly feels riskier, maybe, or confusing. So from your perspective, when's the sort of right time to consider debt for a business, and sort of what tends to make a business ready for it?
Yeah, I think it's quite easy to think, but it always gets forgotten. There are two key things from our perspective on debt. Right, debt has to be serviced, and debt has to be repaid eventually. Which is very different to equity. You can raise equity, and technically equity doesn't have to be repaid until there is an exit event. You can structure, we structure debt depending on each business and the risk profile, and you can be interest only and you have more of the balloon at the end. But ultimately, there's going to be a refinance or a repayment, and there's always an end date from a commitment perspective on debt. So when we're looking at debt, the key thing we focus on, and for businesses to focus on, is one, can what I'm taking on today and what I'm agreeing to service, both in terms of interest and capital repayments, can the business do that? And without the growth that you're projecting, because that's upside for equity for yourselves. Debt doesn't really need that upside to come through. It needs sustainability of that business, and two, what does that end position look like? Because markets can change, banks' appetites change, and I think some of the issues might not be a business issue, it might be a wider economy issue where the level of leverage that was done in a year is different to when you're coming out of refi. So being aware of that's quite important. Generally, when you're looking at debt, when you're taking on debt, we look at the business has scaled to a sufficient level, is generating profits, and cash flows to be able to service the debt from an interest and whatever capital repayments that are agreed. And in terms of kind of scale, it goes beyond just financials. We're looking at scale from diversification of revenues, diversification of customers, diversification of suppliers, diversification across key earners in your business. So all of those kind of downside risks are the mitigations to that is what we would look at from a debt perspective, or what you should also look at when you're raising debt, because the upside is great. As I said, it's if any of these are tweaked or a key customer gets lost, then especially at scaling businesses, a small drop in revenue can drive a much bigger drop in EBITDA and profitability and cash generation, and suddenly it can spiral into a situation that you'd have never thought about, because you're always generally thinking forward that these customers always remain and we're going to keep adding. So at OakNorth, when we're looking at when's a business ready for debt, we typically look at at least 2 years of growing profitability and cash generation, and that's what we'll use to structure the debt profile over the next, say, 5 years, the capital repayment profile, and see if the business can afford that. We don't need that. Founders sometimes show us the hockey stick, same deck that they're showing to their VC or their equity providers. We don't need to use that. We'll probably just put a line across that, because that's upside. We don't benefit from the upside. Our upside is capped to the interest we charge. So we are all about what can cause this business to go backwards, and if those risks are mitigated or there's good control around that, then a business is ready to take on debt, and then we're there to then enable that growth to go forward for the benefit of the businesses effectively.
Great, thanks, Navin. So I guess weighing up equity versus debt, there are pros and cons, and I think everyone, even different types of equity we've talked around the room today, there's pros and cons to all types. But could you sort of walk us through sort of how the cost of debt compares to, obviously equity can come in all shapes and forms, but compared to the potential sort of cost of equity, and sort of how best to weigh up those trade-offs at the point at which debt becomes a possibility and an option, how best to weigh up those trade-offs?
Yeah, I think so. The cost of debt is unsurprisingly cheaper than equity, right? When you're scaling businesses and you're raising funds, either debt and you're considering debt or equity, and you've got a plan, and if that plan is delivered, then the natural view is actually you're giving away so much of that upside that you worked so hard for to an equity provider. But that's what in my view, that's what equity is there for, is to provide that flexibility, the freedom to achieve that top line growth. Debt, can support growth once the underlying business has achieved sufficient scale, but it comes with, debt comes with controls. It comes with covenants. Because the upside is capped and the focus is on downside and repayment. We want to make sure the business can actually, it doesn't overtrade. You don't go chasing growth at risk of destabilizing the good business that's already been built. So from a cost perspective, it's cheaper, but there's I think, being very open, there's an opportunity cost of taking debt versus equity. So whilst the cost might be cheaper, the growth projections might look different. Being bootstrapped, there's an opportunity cost versus raising equity. There's same as with debt. So we tend to find, and we generally see scaling businesses, unsurprisingly take equity first. Not all go through VC. It's not a standard process where they'll do angels, then VC, then debt, or then PE, then debt. It can be at any stage depending on how fast they're scaling or how quickly, what the strategy is of the business to reach profitability versus scale. So, for example, OakNorth, our founder Rishi and Joel, their focus has always been we want to scale profitability wise. So, first thing is we want to get to a profitable position, generate cash, and then take scaling from there, rather than to grow top line and keep think about cash flows, but at a later stage. So if you're doing that, then actually raising debt becomes an option much earlier in your journey. But if the focus is on scaling the top line and the investment continues to go in and the cash flows will come at a later stage, then you have to be looking at a different instrument. In terms of cost, debt is typically in the single digits percentages plus base rate. But again, that interest is very rarely just capitalized. The business has to have the cash flows to be able to service that along with the repayments.
Perfect. And in terms of, as you alluded to, OakNorth founder-led, we very much sort of approach debt slightly differently in terms of the process and our sort of credit process. But if something goes wrong in this sort of process, having taken debt on board, how much sort of flexibility is there, and sort of what does that look like for a business having taken debt on?
Yeah, I mean, it'd be great to hear from yourself around, what went wrong with debt. Look, I've been doing debt for 15 plus years, and generally, the banks don't want to take your business. Banks don't know how to run your business, right? The focus for us is, if something goes wrong, one, is there commitment from the management team and the founders to get the business on the right track, and two, there's commitment, there's focus to do that, and we want to work with you to put that into action. Now that might mean further debt needs to go in to enable that process to happen, but then there needs to be a route out. Typically what we would see is things can go wrong and often do go wrong. And we do a lot of real estate debt, we do a lot of cash flow debt with no real security. In development, things can go wrong where main contractor will go bust, and the costs escalate. You'll have to think of a way through. So as long as there's commitment and there's a collaborative approach in kind of restabilizing that business, ideally that's what the bank wants. When we're looking at coming into the business day one from a debt perspective, one of the things we always consider is if something were to go wrong, is there follow-on money available, or does debt become the lender of last resort very quickly? And if that's the case, then you're assessing that situation from a very different angle. Debt comes with covenants, and they're not just financial covenants. They are, there's other restrictions around, what you can do in terms of size of acquisitions and cash out, etc. But all in line with the strategy you're putting in place. Now, even in financial covenant, there's profit-led covenants, there's cash flow-led covenants. So there's early warning triggers that we put in, but with a good level of headroom, and they're always set at, not against that. Again, coming back to the high growth case, is set against generally a flat case and with headroom on top of that. So when they bite, the business has generally gone backwards. So it's not unreasonable at that time saying what something's gone wrong to where we were day one, and the risk of the bank has changed from where we went in. Not you haven't delivered your growth plan, it's gone the other way. So what's happened there and how are we correcting that? So I think that's the bit where collaboration comes into play in getting it back on that right path. But yeah, what we, in my history, is very rare that a bank will just, when it's a good business, will say, we're just going to take the keys, because that's the worst thing you could do to a business. And actually, the capital is put in the business.
I think what would be interesting as well is also to understand difference from OakNorth and other banks.
Mm-hmm.
Because for me, it's like you're talking as a banker in terms of saying, right, there's equity and there's loaf. And, as long as your business is profitable, which, startups can't be, and as long as it's got enough cash on the basics, then, it'd be quite interesting just to understand the difference with high street bank.
Yeah, so one of our key points of difference in the debt process is when it comes to a credit committee, the traditional bank process is you as a founder and the management team will present to the bank, and the bank then goes to speak to the credit team. It becomes Chinese whispers. We're not an expert in your business. You are. So with our credit committee, the founders and the management team come in and present the business to the credit team, including some of our key decision makers in the business. Similar to if you were going to go and raise investment, same principle. It's that entrepreneurial approach to go, your business far better than we can. It's a quicker route to a yes. It's a quicker way to understand if there's any questions that need to be ironed out. And also that buy-in piece that Navin talks about as well. We get to test that, and we get to understand that there is key buy-in from all of the people across the business and running that business. So that's one of our real key points of difference, and it means that we can move at speed much quicker with our decisions than sort of traditional banks can as well.
Yeah. But it doesn't go away from the fact, your point around, and you're right, at startup phase, debt might not be possible. But again, we're very open with that, and what we don't do is saying no and that's done. It's about, okay, where's your journey at? How can you keep speaking to say, when's the right time we can start considering it? And it might not be core debt day one. It might be working capital facilities, and then you start building that relationship, because once that relationship built, the bank starts to see funds flow through, starts to see interest being serviced. That next stage of, okay, I want to take leverage in my business for that next stage of growth, be it an acquisition or be it an investment or a rollout strategy. Those conversations become easier once that base relationship is built. So it's not always kind of coming into an OakNorth or any bank to say, I want to take 2 times what I'm earning, or look at my revenue profile, I want to borrow on that, and I'm going to deliver this. Just because we'll be like, well, we're not participating in equity, and that's not going to be there. So again, coming back to the risk on the downside is much higher for us at that stage.
Yeah, I think it hit the nail. There's 2 types of people in this room. I have those that actually have a product and are selling, and those who have no money. Either they're looking to raise cash, or they've raised cash, but they're not going to be profitable for 5 years. So but you're an example of the sweat lottery, stuff like that. Biotech is the same way. So I think we have to consider these 2 different approaches. I've been both, and I just remembered actually in this conversation, when you said it, and when you said it all depends on the economic climate. So I set a company up probably about, 28 years ago, can't remember, it was a long time ago, and Lloyd's had one of the first in Cambridge business banks, science banks, or whatever. There's a guy named David Pope, I remember this day, I went in and talked to him. And so I set the CRO up, which is unusual about biotech. It's a contract research organization, so you can actually generate income through service work. You don't have to raise cash. I never had to raise a dime. He gave me an overdraft. So I had a few customers, and I think I got a £250,000 overdraft. And there was he wanted my house. I'm like, no freaking way. My wife's going to do that. But my coin is, I think the Economic Times in 2000, it was a long, long time ago, was such that the bank was really on your side, and they were really good. Today, good luck with that. I'd be really surprised if they'd take that approach. So, I guess my point is, what is today's economy like? How you can help maybe the people that don't have, because it's easy. If you got 10 million in the bank and you can use the money to, start a new product line or something like that, and then that is probably a good option. As long as you go in there with your eyes open that if it doesn't work, they're going to take it back with 20% or whatever, stop you making key decisions. Or if you have IP in the company. I remember talking to SVP, they wanted, again, this was in the richer times, like, oh yeah, you just raised some money, you got $5 million in the bank, what do you do? But if you don't pay, it's essentially a loan note, we'll get percentage of your company back. So in worse terms than your VCs. And at the end, if all goes tits up, we'll take your IP, which is the only thing valuable in the company. So, I guess my question is how, if in the current economic climate, how can you help those of us who are just starting this? I mean, my answer might be no, not do anything. But are there any ways to help people when they're just getting started?
It's a very good question, but it's difficult, right? Because you can go in just like you say. Some of the other lenders will look at it and say, we'll provide that money, but if you don't pay it back, we're going to take your shirt, right? We're going to take the keys, etc. That's not what OakNorth is. Like we've lent close to 17 billion. Our capital losses over 10 years have been 6 million. So it's making sure that any money that we're putting in, it's sustainable for that business. Then the last thing we want to do is something go wrong and you have to, something that's been built and is successful on the right trajectory to have to cull that. So a lot of the time, unfortunately, at early stage, the answer is no, but it's for the right reasons. Is because we know that actually dangling, a little bit of some financing now, when there's desperation or there's a limited runway for a business, it'll be taken on. But in 6 months' time, when there's a first interest payment due, or in 3 years' time where the capital repayment is due or refinance and it doesn't happen, then actually the founder has no other options. And we have to take that into consideration of if you are if you're looking at a business from as if it's your business, would you want that business to be taken on that debt? Because at the end, when it comes around to it, there's no way they're going to repay it. So most of the time we're very honest, but it's never a no and good luck. It's let's keep talking. Let's see where you get to for the next few months. And these are the milestones that we would expect. As you reach those milestones, let's talk again. So it becomes an iterative conversation. So then that the business we speak to are very clear on what do they need to start looking at debt, and we're very clear that once they hit that, we can go with confidence and deliver that for them. But yeah, at early stage, it is difficult, but I think for the right reasons.
Yeah, and I think the OakNorth approach, as you say, alongside that is at an earlier stage, where else can we help? And that is about, a bank that can understand a business on that journey. There are other challenges alongside the debt as well. Can we, create an ecosystem to connect the dots, add value in different ways? If you're looking to raise investment, are there investors that we know that we can sort of connect the dots with and things like that? As I say, it's an entrepreneurial approach rather than a traditional bank approach, which is this is what we do and that's all we do. This is a computer says no approach. Ours is actually let's create an ongoing conversation on the debt piece, but in the meantime, can we add value to you? Can we give you a better rate of return on that money that you've worked really hard to raise, that actually then going to pay for a couple of members of staff having the right rate of return on that journey. There's lots of ways in which we want to try and help on that earlier stage. Conscious that we sort of want to get to more of a group discussion. I guess just one final question, Navin, from your experience, have you got a sort of a real world example of a business where a founder sort of used debt and equity and used it really well to their advantage on their growth journey?
Yeah, so recently we did a deal in the hospitality space, which is obviously a very tough space at the moment to lend to, but a very good business. They'd scaled to, I think, 4 sites. Again, with 1 round of VC money. Scale. They stopped scaling through COVID. They cut. They kind of rebased their operations, their cost base, focused on margin. So did all the right things that a debt lender would want them to do. And then they went back on their rollout journey. They did another scale up, another new site, And then they came to us say, look, we've now achieved this. We've shown how we managed through a full shutdown, come back out. We've got back to pre-COVID levels. Now we want to scale. But when we scale, the next operation, we're going to need CapEx. Those sites will take time to get to profitability. And how is this the right time, or are we not of good? Have we got enough to raise debt? Where we got to was we couldn't do the full next set of rollouts through debt, but we split that funding with some VC money coming in, and we end up lending, I think, close to £2 million to do the next 4 sites alongside VC, which was great because for the VC and for us, it showed that they were fully committed. The VCs got to, I guess, share in the upside of these new sites without putting all the funds up. The founders didn't have to dilute as much. And for the bank, we saw we had the track record of the business delivering successful rollouts. And we knew that there was commitment from the VCs to continue to support this business going forward. So it was at that stage where they'd done a good amount and then they wanted to, again, do another step change. And that's when we come in. And, there's various examples I've worked with for things like acquisitions where businesses reach a sufficient scale, they could keep going organically, but they see another small, another similar business that, might not be, going anywhere, but they can see a quick, more than doubling of the EBITDA if they bought them out. That's when we could provide leverage, and we have provided leverage for those acquisitions and things like that. So there are examples, but they all tend to have a broadly stable base business to then go on from.
Great, thank you. So James, I think it would be good if we can sort of basically open up. We want to sort of hear from you, and I think all of you will have different, as we alluded to at the start, different sort of capital stacks and different ways in which you've sort of got your businesses to where you are now. So I guess it would be great to sort of open up with what's the biggest challenge with your current sort of setup as a business in terms of where you've got to. We heard some of them are more intentional than others, but sort of where you are right now, what's the sort of biggest challenge or unknown with your current sort of capital stack?
Location. I actually, through various businesses I've founded, and the funds that I've raised, very little has come from the UK. We don't start using I talk shit about the UK. That session. It was going to come up. It was probably going to come up as part of the conversation, but yeah, money then is certainly much slower here. Going to the US in particular, I've found that you get a quick no and a quick yes. And from the point of a yes, the money is in bank pretty quickly, whereas here, it might take a while to get a yes, and it takes them longer to get cash, and sometimes you get demand. And so that's problematic.
I think also the same when we complain about VCs, that's more likely the case as UK VC. So you put for bit European VCs. It's a usually we found, in the US, exactly what you said. The money comes, we have quick conversations, everyone's on board, bomb done. Here, I have to stand backwards on my head.
I think also with VCs and small funds, often the question is, you have all these conversations, you put a lot of effort into sort of having those, thinking that it's an investment conversation from their perspective, it's a research conversation. Something in your brain?
Yeah, and I think that's a blood sign. Because obviously they're just sort of fact finding, aren't they?
Yeah.
Particular industries.
I think it'd be interesting as well to start almost at the end. So Oliver, I'd love to pull you into this conversation where obviously, I don't know how much of public knowledge, so hopefully I'm not giving everything away here, but you're looking towards an exit.
Yeah, we're 50-50 whether it goes the path of funding for more growth or an exit.
And with those two options in mind, what I'm kind of getting at is retrospectively looking back at how you have set up, whether intentionally or reactively.
The two personal pain points I could share are, one, earlier this year, I was looking at growth through a new revenue stream that I think will be really successful. But one of our convertible loan note holders security blocked it and just simply said, I'm going to call my loan note in if you try it. And really try my best to convince him. But he had another business which is in the sector that I was hoping for our Hindi. So he had very strong opinions. I think someone failed him from that. and we do, and actually, we do electric bike conversion, and we were looking at just branching out into complete bikes and complete electric bikes as well. Really cool, but he has had lots of bad experiences of bikes. There are some horror stories like Van Moof where people try to do complete bikes and fallen over, and he was really wanting us to not take on that risk. I think it's a terrible decision, and now we're looking at potential. We're speaking with some identifiers of a business that really want us to go into e-bikes. So, right. So now we've got a bit of a, and then the other point is the drag along percentage. 85% is our drag along percentage, really high, and it's really hard to get all our investors on the same side of that. So, I mentioned to James earlier, when I was funding money, I was very much get the money and worry about the people later. Looking back, I don't think I really had a choice. I'm not sure I could have picked and chosen at any point really, but I'm definitely seeing now the impact of who is on the cap table and what their opinions are. So yeah, tricky time, but it's all experience.
I think one of the important things is in setting up any company is always looking to our tools first. Like, I'd never go into a company with less, you don't want more than 60% drag along at any point. And to be honest, people investing early would not even look at that, wouldn't even notice that. But you could look to change your articles, and then you set it to 5%. It's 10% less, so you could change.
Yeah.
We had that kind of stuff, but then when we did the Delaware flip, everything was such a rush. We just ended up with like the most basic default US documents. I think at least half of our investors, they didn't even understand that they came up like half their rights because we were rushing. So
Until it exited.
Yeah.
And you got Chinese investors. Good luck you trying to contact them.
Yeah. Yeah, that's another thing. You actually end up getting ghosted by some of your first sales. And like, what are you gonna do? You need to design something.
Yeah, I think you said, James, you get your investor mix right, or if you're very, you got to get the right investors. VCs are fine if they're on board. And the same, and everything you just said about we're entrepreneurial, your VCs are going to say the same thing.
Yeah.
And they probably have a lot more experience in doing that. So I'm on the VC side, but there's a lot of VCs out there, and granted, there's a lot more in the States. Everyone probably goes to JP Morgan every January for the EC Fest, at least in life sciences. There's a lot of them out there, so be selective. Although when you need the cash, I guess beggars can't be choosy. You kind of have to kiss a lot of frogs, and maybe you get a couple on your board. But I think you need to be very selective. But they can be great and very entrepreneurial. Help. They got a great network for investors to help you.
Yeah, when I first set up my previous business, Comfortable Sport Lobster, raised funding through family offices on VC terms, and they held you and controlled you, and it was pretty challenging. And someone said, like, you said you can pick and choose. I was kind of naive, so I was like, great. So we did a deal, and didn't know them too well, and then got to know them better. And so coming into my next venture, I actually went the opposite way in terms of control and made sure that the articles, I had like 3 votes for every share that I held. The board was not court unless I was in attendance, and things were not approved unless there was a majority, including my votes. Like, I went completely the other way and raised capital from high net worth who didn't look into that kind of stuff. They were like, fine. Then the challenge is then as business starts scaling and you're looking for support from those investors, with 30 odd high net worth on their cap table. They start ghosting you. They can't write bigger checks, etc. And then you're trying to pull in capital from, shall we say, more sophisticated investors and later stage investors. And they look at the structure, and then they look at the busy cap table, and they're like, well, there's a lot of dead wood here as well. So then it's like, oh shit, okay, well, how do we reorganize this? So I've actually found, so far, touch wood, this is the first time I've taken venture money, of course, venture terms, but from venture capitalists, and they've been the best investors I've worked with. I've gotten to know them over the past 2 years before they made the investment, which made a massive difference. But it's not always the way, right? I mean, when you need capital and you're running up against it, and there's an investor that's offering you capital and you want to take it, sometimes you find out more what their sort of true colours are. And in fact, unfortunately.
Yeah, I mean, Elena, you've got almost a this might be a push, but a dream scenario where you are significant revenue, significantly pro,
Yeah.
but actually bootstrap to this point and now just looking into it. So
No, but I'm very interested in the growth because when you like this year we are like doing full multiples, and next year I want more, and it would be really nice to have like a brand who already did it for with others and exited very well. So in a way, for me, it's like a game changer, right? You know, to have another one who is in the same sort of position and wants your growth. And also, like when you're doing something in a smaller level, you have different budgets, right? It's not necessarily that you're scaling and it all goes the same way. So in a way, experience matters and money as well. I mean, to the less extent.
what are your, from the exposure you've had, what are your thoughts in terms of debt or VC or angels?
That's what I'm learning. I had
Yeah.
no idea. I'm in a very luxury position, but it's very interesting to listen to these conversations and to see, you know, how to choose and pack this skill like a puzzle. But in a way, it helps me very much because I sort of understand that there is a way. You have to be careful, and if you are not pressured by time, so in a way you can find ideal people who will back you or will start working together with you, right?
Yeah, exactly. Yeah.
Never hold your advice, Steve.
I think it's really interesting on the equity side around you basically who you're getting in bed with, right? Because when you're at a time where you need the funding and you've got limited runway, as you spoke, you take the first check that's put in front of you, and then you're the new baby in that portfolio. So you get a lot of attention from the VC, a lot of introductions, etc. And then soon, if that growth plan that you've kind of you showed them doesn't get delivered, the tune can change very quickly.
Yeah.
And then it's very much like, what are you doing about this? What are you doing? And then it suddenly starts becoming, opposite ends of the table.
Yeah.
Whilst they don't have documentary controls around your day-to-day operations, they have, they've got you because they've got control around your business very quickly.
Yeah.
And so then it comes down to actually, if you're, depending on kind of the pace of you want to scale and the options you have, debt is a completely different proposition because we don't have any of that control issues or controls in the documentary around ownership. It's all about performance focus. It's all about growth and sustainability. So when you're looking at debt as an option, the focus I would always say is around the covenant and those levels, and almost it should be, if I'm agreeing to them, I know that there's going to be a minuscule chance of me breaching them because I have that much confidence in my business. Because it's like, if the bank is considering that as a downside, you should be thinking that's never going to happen. In that case, debt becomes it should be a risk-free capital for you to grow. So it's looking at it from a completely different angle. Debt will, we have relationship with VCs, we have relationship with other businesses, and business in the industry where we can make introductions around knowledge. So I don't think that goes away with having the right debt provider. And I know you probably don't get that as much from traditional lenders. Will they lend you the money and you become a 1 in 100 portfolio client? It's different at OakNorth. It's all about that collaboration, and hence why we do things like this. So you can get those benefits while still being able to scale the business. But the rate of scale might be different against what a VC will give you, and the freedom they'll give you from a day-to-day perspective. So it's always about kind of balancing that.
Can I just ask a question about the deal you were talking about earlier in the hospitality sector? You lent that business £2 million. How much impact did the knowledge of having investment coming in at the same time impact that decision? Would you have given £2 million without that investment, or did the investment increase that amount?
So I guess if they hadn't had that investment, they probably wouldn't have scaled to where they got to, first of all, right? So if they had it, and it may have taken a longer period, but assuming they got to where they did, that wouldn't have changed our approach of whether we lend to that business or not, because the fundamentals had been built, that the business was successful, they were delivering, they were getting people through the doors, etc. Then it would have been the case of how much can we lend in terms of the pace at which they scale. So they wanted to look at the next 4 sites, which are actually, you want to do next 4 sites in 12 months. That's too racy with pure debt because of how much it will kind of eat into your cash flows. So be like, okay, we would have had to look at it as maybe one every 6 months to make that growth journey a bit more sustainable. So it comes back to actually, but because it was 50-50 debt equity, we were able to say debt's not taking all the risk. There's equity capital coming in, which doesn't need to be serviced. Leverage is lower, so you can allow a faster pace of growth and in a controlled manner still.
And how do you take that into account? Sorry, how do you take that into account when you're sort of doing it? Because obviously you need, I don't know whether they will have received that equity financing by that point. Do you have a conversation with the investors?
Yeah, so there will always be the conversation, but then in our, so we would provide the facility, say we provide a 2 million facility, it doesn't need to be drawn day one. They'll draw it as the CapEx is spent, but the condition will always be that it's 50-50 debt equity funded. So it's on the onus is on the founders to say, yeah, we've got equity and we're going to abide by that control in the debt document. So when they deliver us the utilization request, say we want to borrow 500,000, we would want to see evidence that 500,000 is coming from equity as well.
Right. So this is something I'm quite interested in because I mean, we've gone through hell and back, especially 23 to 25, where venture was just basically on its knees. Where I would never want to get in a position again where we be absolutely outright capital. So this is saying ourselves. So going into this funding round, which we're looking to do, that's something that I was praying in my mind is basically you get venture funding and you match it or part match it with debt funding. Because there's obviously security for the debt lender that there's a fund in significant amount of capital. But then you start to have competing interests because I mean, for all of us who've raised venture funding in the room, the fund wants you to have another funding event to bump the valuation. The team wants to have sustainable growth and to stay alive. So how does that work from a conversation standpoint where, I mean, realistically, and I had this conversation earlier over coffee, we're at this point where we need to decide, do we go after the 100 million pound exit route or do we go after the 10 billion pound route? Because those are very fundamental differences. But there's a really real world example in which we raised funding, got some debt, and we never need to raise again. But that would almost be to detriment of the fund that we took on board. So how do you guys see that? And in experience of seeing that with matched funding on the debt side, does the company suddenly grow really quick to satisfy the fund, or does the company suddenly start acting a bit more responsibly, knowing that it has the debt funding there for a rainy day? What have you guys seen in the past?
In those situations where you're raising debt alongside equity, if the debt is being spent day one, then it's different because you've delivered the impact from that debt. So if it's an acquisition where you're putting 50-50 debt equity in, the acquisition is made, it's bumped up the profitability or the scale of that business, then the next stage of growth might be actually, I want to go and do a full equity round because the level of risk I want to take on that transaction is very different to what I did on the previous one. Debt's never going to cap growth because in any sense that the faster the business grows, the downside risk goes down further, right, to where we underwrote the debt at the point. The balance always is, from a VC perspective, is the fact that you take on debt with controls around financial covenants, controls around interest payments. It changes your ability at the pace at which you're able to grow and the decisions you're able to make from a day-to-day operations perspective. And that's always the balance for a founder and the VC is that those financial covenants and controls restrictive, or they're not an issue because the level at which we're growing. If they are restrictive and the business needs to act differently to what the VC strategies of that business, then actually either you haven't got the right VC or you haven't got the right debt partner, or the combination can't work at that stage in what you're trying to do. So I think everyone has to be aware of what those controls are, and debt will always be with downside controls. Is to be aware of and be comfortable with, one, they're not going to be an issue, or if they are, we can still grow sustainably alongside them. But when it comes down to the next round, I guess then it comes to a point around is your next round, whilst the VC might want a next valuation point to bump their valuation, actually using the debt now with less equity is going to help them anyway for that next round, because it's not going to be that actually the business, and we never see a business do one round of funding and then do nothing, right? Even though you think that's the case, the next opportunity will come round, and there's always a case, or there's another minority, or you might want to change that VC out, you might want to go down the private equity route. Something will happen. It is very, very rare that a business will come to say, and we do actually very often have business say, if I raise this, I'm done, and I can see my profitability go like this. I'll repay you, and it's happy days. I can go in the sunset. This is a cash cow for me. Founders just don't live like you guys don't live in this, like, you don't say I'm done in 2 years and I'm just gonna just chill out. Like, the opportunity will always, another opportunity will always present itself. So
And
I think it's being aware of
an
that.
exit, because I heard exit into stuff. Something? Yeah. I think it's there's nothing wrong with that. So the first question I always ask, what's your exit plan? Nothing wrong with a £100 million company. You can go and do it again somewhere else and learn from your mistakes, or go into other opportunities. But the thing I'm keen on is pace, and that's where and you also said I could keep this for a rainy day, which is not the way to look at private debt or any financing is a way. I think the absolutely key in all of our sectors is pace. You have to move quickly, otherwise you're going to lose it. You lose the time. You use your staff, the momentum. You'll get bored. I've never worked anywhere in my 5 years, right? So you're going to want to do the next thing. So use that debt for a particular, you're buying another franchise, or you're building a new product line or whatever. Absolutely have what is it you want to do with that?
And I would say, think of it, you need to sort out, do you want to be the 100 million or the 10 billion? And just laser-like focus on that, and ignore your board. It should be you, CEO, and it should be what you want to do. There's nothing wrong for going for a quick exit.